A lot of people are struggling with the valuations and saying it can't go a lot farther because of that. And I disagree with all of that. I think as I've been saying for a while, we're in the final leg of a 43-year secular bull market. I think this final leg is going to be pretty exciting, pretty steep. We could by Labor Day, or certainly by sometime in the fall, make a top. And that top at this point, as you said, I've raised targets, so I'm at 8,000 on the S&P, 27,000 on the Nasdaq, 55,000 on the Dow, and 3,300 on the Russell. If anything, I'm going to be raising those targets. So I don't think they're going to fall short of those targets. So I think there's a pretty good sized runway still ahead of us.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back the one and only David Hunter. So David is Chief Macro Strategist of Contrarian Macro Advisors 52, and he's one of the few people who's been sort of bullish over the past few years at the right times. And obviously there's been quite a large return since that period, and I think he thinks it's going to continue to melt up as he coins. So David, thanks so much for coming back on the podcast.
Yeah, hi Anthony, great to see you.
Yeah, great seeing you too. I think it's been about 6 months, and we're just saying that it feels like years since we last spoke because of everything that's been happening in the macro and the geopolitics. But markets are at all-time highs; they don't seem to care. So I'd be really interested in hearing your current outlook of, what are you seeing in the economy and markets?
Sure. Excuse me. I remain bullish, of course. I think the street continues to fight this thing. You're getting more jumping on the bandwagon, but still. For so many, I think they're either worried about a double top or something just above here and then rolling over. A lot of people are struggling with the valuations and saying it can't go a lot farther because of that. And I disagree with all of that. I think as I've been saying for a while, we're in the final leg of a 43-year secular bull market. I think this final leg is going to be pretty exciting, pretty steep. We could by Labor Day, or certainly by sometime in the fall, make a top. And that top at this point, as you said, I've raised targets, so I'm at 8,000 on the S&P, 27,000 on the Nasdaq, 55,000 on the Dow, and 3,300 on the Russell. If anything, I'm going to be raising those targets. So I don't think they're going to fall short of those targets. So I think there's a pretty good sized runway still ahead of us and directly ahead of us. You can get short-term pullbacks, but nothing. I don't think you're going to see anything of certainly not the magnitude of what we saw in early April, and probably not even half of that. So you can get a 4 or 5% pullback at any time. In recent weeks, I've been saying. And that was when the S&P was down at 58, 50, somewhere down there. I was saying, it looks to me like we probably pushed through the old highs by 4 or 5% and then come back and retest those old highs. So, that means you still got room up. The S&P right now is 6,200. You might see it run to 6,400 or a little higher and then pull back. So that's what I think we're in for, is those kind of pullbacks, not anything major. And basically, I think a strong July, maybe a strong August. We'll see.
Okay, really interesting. So do you see there being maybe a disconnect between the economy and the markets? Because I think a lot of people are seeing the US economy and they think it's starting to slow down. Tariffs is really starting to have an effect on that. So is that what you sort of think will happen?
Yeah, my forecast for a long time has been that we would see the market rise while the economy was moving into recession. So this is exactly what, it was a playbook I called. And I think people did not understand that slowing economy means lower interest rates, means Fed coming on board and wind at the back because the Fed is easing. All that's coming. The dollar's down. That's helping certainly in some areas. So I just think people have misunderstood how markets work and have continually fought this. Now, at some point, the economy in my forecast gets very rocky. In fact, we move towards a global bust. The market's not going to go up in that. But for the next few months, I think the narrative is going to be soft landing, lower rates, lower dollar, um, earnings still being held intact, quarterly earnings still looking pretty good. And so you get kind of your cake and eat it too. P multiples can go up on solid earnings, and people can still remain pretty sanguine about the economy. As we move towards later in the year, into later in the fall and winter, the economy could really start getting a lot weaker. And it's at that point that I think maybe, equity investors are going to have to worry about, the fact that earnings could roll over and get hit pretty hard.
Yeah, okay, makes a lot of sense. So, what have been your thoughts on tariffs? Do you sort of buy into the taco mentality that it's just a negotiation tactic and Trump is going to sort of continue to back down and as he gets these deals, even if they're not very large?
I think it's pretty clear. He was sincere in what he wants to do. I think he likes, and I think others are starting to like the fact that there's a pretty good increase in revenues coming in from tariffs. I think the street's getting more comfortable with the fact that we're probably going to see a 10% tariff across the board in many countries, maybe not all, and in some cases 15%. So you get the benefits of tariffs and the revenues from that, but it's not enough to disrupt the economy, disrupt our competitiveness out there, et cetera. So I think that's what we're looking at, is the street coming around to the fact that Trump did this pretty well. I mean, and they're if you listen to Scott Bessent, Treasury Secretary, it sounds like deals are coming along. So we are going to get I think quite a few trade deals between now and the end of summer. So you probably get the Senate passed the big beautiful bill today, so it goes back to the House, and we'll see what the two can agree on. And I think we probably do get a vote, maybe by the 4th of July, if not by the 4th, probably next week. And so you got Trump getting his big beautiful bill. And then most of his agenda items will be in there to pay for. He's getting tax cuts, and I think he's going to get he's already getting some, and he's going to get a lot more deregulation. And so what you get is Trump's agenda getting pushed through, despite all the skepticism about what he was asking for. And I think ultimately, the market, at least this summer, is going to receive that pretty well. Be pretty bullish about that. And at the same time, psychology is such that, as I said earlier, the vast majority of institutional investors have fought this bull market for quite some time, for really since 2022. They got very bearish, obviously, in April with the tariffs, and they're just coming around now as we make new highs to say, oh, maybe we got to get on board. So I think that's what you're going to see over the next month or two, is the benefit of Trump getting his agenda passed, and investors seeing that as a positive. Deregulation helping the economy, along with the tax cuts, and basically, as I've said for a long time, what you're going to see at the top, which, as I said, could be S&P 8,000 or higher, is most investors all in. Whereas they fought this thing all the way up, they're going to be bullish at the top.
Yeah, and it does seem like that because I think I read it a few months ago that a lot of investors were sort of staying out of the market, especially institutional investors, because they thought the uncertainty, it was too hard to tell. They thought it was going to come down further and further. And they've sort of been caught out now that the market's back at all-time highs. So do you see them sort of starting to flood in, as you said, as these negotiations are successful and a lot of these, geopolitical, macroeconomic risks fall away?
Yeah, I mean, certainly, institutional investors are not. They don't go all out and all in. They are not in cash. They're more defensively positioned. hedge funds might be more shorting the market or more defensive, but I mean more cash. But the the bulk of the institutional investors, they tweak their portfolios so that they're not aggressively betting on the beta. But I do think they are going to have to shift to a more aggressive, more offensive strategy. So that's what I think we see here in the next month. And meanwhile, I mean, you're still hearing talk on the street of, oh, this thing is up there, maybe it doesn't have much more to go. So they are reluctantly getting on the bandwagon. They are not anywhere near all bullish right now. I think by the end of the summer, that may be the case.
Yeah, okay. And as you're saying, summer and then into the sort of autumn and winter is when you see the risks of maybe the economy becoming too much for the markets.
Yeah, it's hard to pinpoint a top, but I think the likelihood is a top is sometime this fall. If not, if we aren't at a top by the end of the summer, and the end of summer is really, somewhere in September, if we're not at a top by then, I think we will be within a month or two of that. So, it's not very far away, but it's a lifetime away, or certainly a big move away in terms of the pricing. Right now the S&P's 30% from my target. The Nasdaq's about 32 or 3% or more from my target, and I think those targets could get raised. So, yes, we might be 3 months away from a top or 4 months away from a top, but we're basically, those kind of returns usually take 2 or 3 years. So to get them in a few months would be a hell of a move.
Yeah, definitely. And have you been surprised, if we go back to the economy, how quickly Trump has moved away from DOGE? Because it seems like it's almost been thrown out. Obviously Elon Musk's left. Now they're sort of fighting. And it seems like the big, beautiful bill is a complete opposite of what DOGE was meant to be, of cutting, reducing the deficit, cutting costs from the government. Now it's basically we need to grow at all costs. So have you been surprised by that?
I disagree with that completely. I don't know where
Okay.
you're getting that from, but I think that's a total misrepresentation of what's going on. The there were a lot of things in the bill, some of which the parliamentarian took out. So he's not getting all his wish list to try to get the sausage made in Washington. Unfortunately, some things don't get through there. But I think Trump, obviously, his biggest agenda items are securing the border, deporting those that have illegally come here, particularly the more the criminal side of that. And so you still have a wall to be built. You still have facilities to be built on that. So he wanted that in there. He also wanted the tax cuts. He's getting those. He does have things in there from DOGE, but most of DOGE, it cannot be put in a reconciliation bill. Those are things that are going to hopefully get passed after the reconciliation bill. It's not going to be nearly $1 trillion or whatever they were talking about early on. I think the battle between Musk and Trump is too bad, because I think it takes away from what really was accomplished early in his administration here in terms of uncovering USAID and all the American public should wake up and realize politicians were stealing their money. Basically, money was funneled out to these non-governmental organizations, and then funneled back into the pockets of politicians, or funneled into pet projects, etc. It is criminal what they were doing, and DOGE uncovered that. I don't think anybody should forget, and I think Musk deserves a lot of credit for what was uncovered, and he assembled a team very quickly that were pretty savvy from a technology standpoint, and uncovered some of these things. Again, you have to be careful what you hear from the news, because the media from day one on this, it's disgusting how much they want to spin everything negative on Trump. Trump is accomplishing so much more than any president in our time has accomplished in such a short order. And what he is doing is trying to undo a lot of damage been done over decades, not just by Democrats, also by Republicans in terms of the establishment politicians down in Washington. I mean, it is criminal, really. Our country has been, our the voting public, or public in general, has really been bamboozled by these people. So I think Musk deserves credit. Trump deserves credit. You seem to be hearing the spin that I think the media is putting out there, and I think it's way off.
Yeah, it's interesting because I think a lot of even macro analysts are saying that he's moved away from Doge, but yeah, obviously you see them as complementary. The bill as well as Doge is complementary
Yeah, definitely.
things for
There
his.
are things in there, but like I said, most of Doge comes not in the reconciliation. So this is kind of step one, and then they can go back and do some of the other things. But he's being blocked by judges. Today they just came out and they're trying to block his efforts to disassemble the Department of Education. He's accomplished an awful lot given the resistance he's facing from corrupt judges from the left. I mean, look at what's going on in Washington. Schumer and his crowd, all they want to do is try to block his efforts. His efforts are really efforts that will benefit the voting public and benefit the citizens of the United States. So the Democrats are nothing but obstructionists at this point.
Yeah, it seems to be the way, unfortunately. And do you see the deficit reducing? Because I guess if we look at what's been happening in the bond market, there's been lots of concern. Maybe this is a narrative as well. There's been lots of concern of the blowing out of the deficit, how there's going to be a need for continued issuance of debt, and that's going to potentially increase yields. Do you see that being an issue moving forward, or do you think they can sort of bring that under control?
Yeah. So it obviously, if you do it on a static basis, which is what the CBO does, the Congressional Budget Office, if you do it on a static basis, you've got deficits for as far as the eye can see to the tune of $2-3 trillion. And that's what Wall Street's worried about. That's what the bond market's worried about. Unfortunately, too many people do not understand that supply side economics does work. That if you get the deregulation that Trump is putting forth, if you get the tax cuts, if you get some of his other agenda items, you will see an economy prosper, and the deficits will come in as you generate more revenues. And we're already seeing, although I think some of it will change, obviously, with the economy softening and ultimately a bust. That'll definitely change things. But at least so far, all the doom and gloom about what Trump's policies were doing in terms of driving up, the costs and creating higher deficits have proven false. It's early, and I think some of that is going to come in. But the fears of inflation from tariffs, the fears of massive deficits from his programs, all that's I think a lot of it's um, people trying to convince the public that he's a bad guy or that he shouldn't be there, etc. So I do think that ultimately we're going to be pleasantly surprised in terms of the deficits, because I do think the tax cuts are going to make a difference. Again, I understand we're really just for the bulk of the tax cuts, we're just keeping in place what we already have. So that's not necessarily additional stimulus, but we are, no tax on tips, no tax on overtime, the the tax credit for Social Security, along with some of the business tax benefits that are being put in here, all should stimulate the economy relative to what we did have. And so I think, again, CBO is always wrong on this stuff. They always do this from a static standpoint. They're only looking for 1% growth in their model to talk about what the deficit's going to be in future years. I think you can count on probably 2.5% or higher in terms of post bust. Now, the bust is going to wreak havoc in terms of all of this. So I still am a bear in terms of what's coming. But the second half of his administration, I think you'll see some of the real benefits from his agenda.
Okay, really interesting. And I think I've heard you talk on another podcast where you said you think this is maybe the peak of the yields, at least the US yields, and potentially bonds could start to go up. Living up to your contrarian name. So why are you seeing that? Is that all linked to what you were saying there before with the economy, and as well as maybe the Fed coming in and reducing rates?
It's the whole story of I think the bond market had bought into all of the fear mongering out there about higher deficits, having to sell this huge supply of treasuries, which they do have. I mean, their funding costs are high. So you had the run up in rates from just below 4% back to, I think it got up to 470 on the 10-year, or 460, I can't remember. And before we rolled over this time again. And it was, I thought it was much ado about nothing. It was a lot of psychology driving the market rather than reality. The economy's slowing, inflation's slowing. The Fed was not on board, so they were listening to the Fed, who whether it's politics or wrongheadedness, is underestimating the rollover in inflation and overestimating the inflationary effects of tariffs. So all of that kind of came together this spring and caused the run up in rates. We're now seeing obviously rates retracing back down, and I've been the bull on the street in terms of saying, in the bust we could see the 10-year down to 0%, and short rates even in negative territory before the bust in this final melt up rally in the markets. So in the next 3-4 months, you could see the 10-year down as low as 2.5%, certainly sub 3% is my call. So I'm, there's nobody looking for that, I don't think, outside of me, but I'm pretty confident that you're going to see rates down a lot from here.
Yeah, I think most people are thinking they're going to go up potentially 6% or higher. So that would be really, really interesting to see. And you've mentioned, you've obviously, I think I remember talking to you a few years ago and you had a price target of 6,000 and people thought you were crazy. And now we're above 6,000 and now you're saying 8,000. So, what gives you the confidence to be able to make these?
Actually, when I raised my target, I raised my target to 7,500 last year. I think I may have raised it 7,000 in January of last year, 2024, and then raised it again in I think September to 7,500. This most recent increase to 8,000, I did that at the bottom of the sell-off back in early April. The tariff sell-off, when everybody was lowering targets and talking about a bear market and the top is in and we're going a lot lower. Market got down under 5,000 and I raised my target to 8,000 because the hysteria, the negative psychology was so great. You had everybody sitting on the ledge ready to jump. And that's all future buying power. That's what I call the wall of worry. Wall of worry had been rebuilt with that sell-off. And obviously, we've seen the results since then. The market has had an amazing run back from 48.50 all the way back up to new highs. So, and I think that's going to just continue. So, yeah, I think most of the street got it wrong. Amazingly, the retail investor got it a lot more right than have the institutional investors. They stayed the course in that tariff sell-off to a large extent and have helped fuel this run. Institutions kept fighting all the way up and now are only now capitulating and saying, hey, maybe we were wrong. We got to get on board.
Yeah, and I guess the challenge, the retail investors, is that this mantra of buy the dip, it's going to bounce back. It always bounces back. And the challenge will be maybe when that doesn't happen. And then a lot of people will be out to dry. But obviously it's been successful the past 15, 17 years.
Yeah, I've been pretty vocal about saying that I'm always telling people on Twitter, don't be traders, be investors. but there is going to come a time here this year where it doesn't mean don't trade out of your portfolio ever. As I've said, in the mid 80s, financial industry kind of recognized there was this rat going through the snake in terms of the baby boom, now starting to accumulate assets for retirement. And they had spent they had their asset accumulating phase for housing and furniture and all those things, back when they were in their 30s and early 40s. And by the mid 80s, they started saying, they started having excess funds that they could put into the market, and started recognizing that even though it's 20 years away, we're moving towards retirement. So the financial industry recognized that was going to be a big business, a big growth business, but they had to figure out how to attract that money, because they were going to need a lot more new people in the financial industry to sell to that crowd. And they realized, this churn them and burn them, pick stocks and build portfolios that way had not been a very successful strategy for a lot of it. And it hadn't benefited investors very much, because a lot of times they were buying stocks high and selling them low. So they moved to, it's not about market timing, it's time in the market. That became the mantra from the mid 80s on, and it's proved very successful, because basically you had this long bull market. So actually, for most people who listen to that and put their money, let's say, in index funds, they've outperformed active managers, or outperformed most traders that think they can go and out, pick a stock and then sell it at a profit. There are good traders, don't get me wrong, but there's a lot of bad traders. I would say the majority of retail people trying to trade end up losing, or certainly underperforming. So by going to this buy and hold strategy, just keep putting money into an index fund and let the compounding of time work on that. It's been a brilliant strategy. It's worked very well. We are coming to the end of that, in my opinion. We, I think, as I said, are coming to the top of a 43-year bull market that started in 1982. And the other side of the mountain, I think, could be an 80% bear market. If we have an 80% bear market, and you just continue with the buy and hold strategy, you're going to be digging out for years. The way it works, if you go down 80% to get back to even, it's not an 80% climb back. You have to go up many fold to get that money back. So I think there is a time when you have to look and say, yeah, timing this market may make some sense. That doesn't mean time it precisely to the week or month or even quarter, but it does mean you can't stay the course and say, I'm just, markets always go up, I'm going to just stay the course, because that 80% is going to cause you probably to spend a decade in the red, if not a lot longer than that. So I do think it makes sense for people to recognize that we're coming to the end of this, even though I'm talking about 30, 40, and in some cases 50% upside from here in the next 3 to 6 months. The other side of that is that there's this huge risk. So you're not going to pick the top. I'm not going to pick the top probably, but you have to recognize you're getting to the end. Time wise, you're very near the end. Price wise, I think you probably you can enjoy the summer and then maybe start looking at what's an exit strategy here.
Yeah, makes a lot of sense. And what's sort of, I guess, segments do you think are undervalued at the moment, or is there anything that you're watching that you think hasn't had that? Obviously a lot has had a run, but that hasn't had a run
there's
yet.
a lot of things that have had runs are going to have a lot more runs. So I like technology. I think technology will continue to lead. Semis have obviously sold off today and recently a little bit, but they've been strong from that April low. And have, SMH, the semiconductor index, has made new highs. A few months ago, people were saying the top is in, the semis can't get anywhere near their old high, the high they made, a year ago, whenever it was. they've had a tremendous run, but I think they have quite a bit more to run. I'd say financials look good here. They have a good upside from here. Industrials have had a good run, but they have plenty of upside still. Basic materials, materials, basic industry, that area maybe has lagged a little bit, and we'll have a catch up. Copper is one that got hit during that April sell off pretty hard and is just now recovering. But copper itself is at over $5 now, and I've had a $6 target for a long time, and people thought that was nuts because it was languishing down in the fours. But I do think that copper producers will do well in here. Consumer discretionary is an area I don't talk a lot about because I think the consumer is going to run its problems as its economy continues to slow. But the consumer discretionary stocks, I think, can perform in this last leg as well. Some of the laggards, I think, are probably going to be, the consumer staples, meaning food stocks, the healthcare stocks. I think will struggle. Housing is an interesting one. That's more discretionary, obviously, but housing's been hurt by the rise in rates. I think as rates come down this summer, you are going to get a bounce in housing. I think the peak in housing, both peak in activity and peak in price, happened over a year ago, at least generally. Now there's different pockets that peak at different times, but housing I think is going to get a good bounce here. The stocks, I think the home builders probably get a nice bounce here and go to new highs. But again, I think we're in the last stages of the housing market. I think if you look out over the next decade, particularly the post-bust period when inflation starts rising and rates go through the roof, I think that's going to hurt housing. So my thing is that you're in I think a final run in housing here, and the other side of it is going to be not what we've seen for the last 20 or 30 years. It's going to be quite different.
Okay. Yeah. Thanks for running us through that. And you've mentioned gold, and you think it's going to sort of keep going up, I guess. I think you've raised your target at 4,000, not mistaken. So you see this, continue with the rest of the market, continue to go up, and obviously the gold and silver mine is going to benefit.
I think metals have obviously silver took a while to get going, but silver is even running now, and gold looks great. Gold had that run to 3,500 back a month or two ago, and it's been kind of consolidating that for a little while here, and people may be kind of wondering if gold's had its move, but I don't think so at all. I think that consolidation is just kind of giving it another fresh start here. And as you said, I'm looking for 4,000 this year. I think this summer you're going to see gold have a very nice run from 3,400 area up to that 4,000 area. Silver is around 36 right now. I think I've got a target of 75 that I think we could reach by the end of this year. So silver should do. I think silver will outpace gold. Both will do well, but that's what typically happens when you really get going in a bull market in the metals. Is silver takes the lead, and it hasn't been the leader, but I think you're starting to see signs that it's going to be the leader. Both, like I said, it doesn't mean gold's going to do poorly. Gold's going to do very well too, and the miners, which have been frustrating for some investors until lately. I think those are going to continue to do very well as they have recently. So that there's going to be pauses. These things don't go straight up. There's going to be times when they get overbought and they need to kind of take a breather. Some of those breathers are high level consolidations. Others you can get hit quickly in a bigger sell off and then come back again quickly. So it's hard to know exactly the path it'll take. But I think the miners look really good here.
Yeah, great. So, David, thanks so much for coming back on the podcast. I really appreciate you having me back. And I think, you've been a very popular guest always because you've been right. So let's see if we get to 8,000. But my last question is, what is one message you want people to take away from our conversation?
Yeah, I would say the biggest message is probably two messages, all connected messages. One is there's a lot of chatter out there trying to talk you out of your stocks. Telling you that it's pretty fully valued and that you should be cautious here. I would say ignore that noise, ignore that chatter, and recognize that there's a big runway still ahead. But the second message kind of goes with that. It's not contradictory to that, but it goes with it, and that is um, that we aren't that far from the other side of the mountain. So don't get caught up in the psychology that I think is going to come with this run. That as I always tell people, the majority of investors are most bullish at the top and most bearish at the bottom. We're approaching a top, so you're going to have a lot of people on Wall Street telling you this thing has legs, that it's going to run for years, that they're not there now. They're skeptical still, but in the next 3 months, you watch how quickly they flip around and they're going to talk, because the Fed's going to be on board. The Fed's going to be easing. Rates are going to be coming down. Earnings are going to look okay, and you're going to have investors telling you, with the Fed just starting to ease, that there's a good long runway ahead. That's when you have to start getting nervous. When everybody is all in, that's when you want to start taking some pieces off the board. When everybody's all out is when you want to get in, and it's the hardest thing to do. Just like if you go back to the April bottom, it was hard to be a buyer at the bottom because everybody was telling you things were going to get dire. At the top, it's going to be hard to say I'm going to let it go, because you're going to watch some big moves come in your stocks. You're going to say, I'm making money. Why should I stop it? Maybe I'll wait and see. And nobody's going to get it exactly right. So I would just caution people, don't get caught up in the noise, because all that chatter is going to be bullish.
Yeah, great. Thank you so much, David. So if anyone wanted to find out more about your work and what you do, where would the best places for that be?
Sure. I'm on Twitter every day, or X every day. And mostly in replies. So if you're only set up to see original posts, you're not going to see me. You've got to have your settings set so you can see my replies, or go to my profile page and look at replies every day, whatever you want to do. But um, there are lots of days where I'm posting 20 or 30 or 40 posts in reply to people's questions or comments. Other days, obviously, slower than that, but I am on there pretty much every day. So if you're not seeing me, it's not because I'm not there. And then I do publish a quarterly newsletter that is by subscription, comes with a cost. If you are interested, all you have to do is direct message me on X, and I will be glad to provide details.
Great. I'll put that description below, but thanks again for your time.
Okay, thanks, Anthony. Good to see you. Enjoy your summer.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.